Welcome to Chapter 18. This chapter, what we're going to do is go ahead and relax the assumptions that we've made in the previous chapters about there not being any international trade, and we're going to go ahead and, for the first time, open up our economy to international trade and look at how that changes some of the dynamics. Well, don't forget, one of the first things is that trade can make everyone better off, and at a country level, we call that international trade. So we're going to talk about international macroeconomics and the trade balance, also known as trade deficit or the surplus, international flows of assets, and exchange rates. All right, so let's recall a closed economy does not trade and an open economy does trade. So a closed economy is what we were assuming before. The value of net exports was always zero. Let's think about these words again. Goods and services, they can be exported, that means they're produced here and then sold abroad, or they can be imports, that means that they were produced abroad and sold here. Net exports is just exports minus imports. So if you have more exports than imports, the value of net exports is going to be positive. If you have more imports, the value is going to be negative. All right, think of some things that affect the net exports, all right? What happens if Canada experiences a recession? What happens if U.S. consumers decide to buy more products made in the USA? What happens if the prices of goods produced in Mexico rise faster than prices of goods in the United States? All right, I want you to analyze what happens to, in all those three situations, just U.S. net exports, not the net exports of these other countries, okay? Just United States. And I want you to think about what happens. Hit pause, think about it for a little bit, and then come back and join me. All right, if Canada experiences a recession, they have less purchasing power and they don't buy our exports. So therefore, our exports would fall. If we decide to buy more products in the USA, we buy fewer imports, so net exports would rise. And finally, if Mexican goods rise faster than prices of U.S. goods, basically what happens is people buy more U.S. goods and less Mexican goods, so U.S. net exports increase. And that's kind of just a really simple way of thinking about it, whereas if there's only two countries, United States and Mexico. All right, what influence net exports? Well, preferences, prices, incomes of consumers, exchange rates, transportation costs, and finally government policies that can affect exporting and importing. Think through each of these and be able to tell me how net exports changes if each and every one of these things change. All right, a trade surplus. So remember, net exports measures the imbalance in a country's trade in goods and services. So if you have a trade deficit, that means you have more imports than exports. If you have a trade surplus, it means you have more exports than imports. If you have balanced trade, it's when exports equals imports. So look at this. In the past 50 years, there's two things I want to note. One, basically, we've been importing and exporting more, right? It's kind of an increase from about 5% of GDP here to around 15% of GDP here, just in general. The other thing I want you to notice is that the distance between these lines has been increasing. The distance between these lines is the trade deficit. So in the United States, we've been increasing our trade deficit since about 1980. All right. The flow of capital. So this is the other side of the coin to net exports. When our United States exports more than it imports, right? We have extra exports that we sell. We have extra dollars from other countries. That means we can go buy products in the other countries. That's called net capital outflow. The formal definition is the domestic residence purchases of foreign assets minus the foreign purchases of domestic assets. It's also called net foreign investment. All right, so it can take two forms, foreign direct investment and foreign portfolio investment. Again, in the situation where my country has more exports than imports, I'm selling my exports to a foreign country, I have more of their foreign currency, I can take that currency. I can't buy anything in my home country, I have to go to that foreign country and purchase. I have two options. I can use FDI, meaning I can take that foreign currency and actually build a factory over there, or I can take their currency and I can buy it put it in their stock exchange. And so that makes my net capital outflow be positive at the same time as my net exports is positive. So it basically measures the imbalance in a country's trade in assets. So when net capital outflow is greater than zero, you have a capital outflow, meaning you're buying more of foreign countries than they are buying of your assets. But when it's negative, that's called capital inflow. That means other people are buying more of your assets than you are buying foreign assets. So what can influence the net capital outflow? Well, the interest rates paid on foreign assets and the interest rate paid on domestic assets, right? People are going to put their money where they can earn a higher real interest rate. The risks of holding foreign assets, right? People like to move their money away from risky places. And of course, government policies affecting foreign ownership of domestic assets. So here's something really cool. Net capital outflow is equal to net exports. Whoa, probably you never thought about this, but it's because every transaction that affects net exports also affects net capital outflow by the same amount. So imagine this. When a foreigner purchases a good from the U.S., that means the U.S. exported to this person, right? NX increases, right? But at the same time, I just sold this guy a good. He paid me perhaps in his local currency. What am I going to do with that except for send the money out back to his country and buy perhaps some of his assets, right? So we buy some foreign assets, causing the net capital outflow to rise. And in the same token, if a U.S. citizen buys foreign goods, that means I'm importing here to the United States. I have to pay for those foreign goods. Well, first, imports rise and NX falls. And I have to pay for those imports with U.S. dollars. I send the U.S. dollars to this guy overseas, but he can't buy anything in his country, so he has to turn around and buy something back from the United States, an asset, right? Maybe he buys stocks from our stock exchange, right? So the other country acquires U.S. assets, causing United States net capital outflow to fall. All right, so how does this work? Remember our GDP identity, and earlier we had assumed that this was equal to 0 because it was a closed economy. That is no more. We're going to go ahead and allow that be whatever it wants to be. So let's rearrange terms. What do you notice about this side? The left side is some sort of income measure minus expenditures. Income minus expenditures, remember that's just saving. What's left over at the end of the day that we didn't eat. So we'll call that saving, and we will have that equal to investment plus net exports. Well, it just so happens that net exports is equal to net capital outflow, so we can replace that. And this gives us a new identity. Remember, in the closed economy case, this did not exist, and savings always had to equal investment. But now we can allow net capital outflow to be a number, and so the difference between savings and investment is the net capital outflow. So when savings is greater than investment in my country, that means that there's extra money going around, and I can go ahead and send some of that money over to other countries, right? Positive net capital outflow. But when saving is less than investment, and this is the case in America right now, actually, we have a lot of investment, a lot of factories being built, but a low savings rate in America. Where do the countries get that money? We get it from foreigners. Foreigners are financing some of the country's investment. And that's the flip side of the coin. When NCO is less than 0, then I know that net exports is less than 0. So when this is occurring, I also know because of this, right? When savings is less than investment, I also know that I am importing more than I am exporting. All right, so let's look at real numbers for the United States. So the trade deficit, meaning the difference between imports and exports, reached the record level at 2006, and it still remained high in 2007 and 2008. So let's recall that net exports is equal to savings minus investment. So if you have a trade deficit, that means that this number is negative. Well, if this number is negative, the only way to do that is to mean that the investment was greater than the savings. Okay, so that's what we've got here. Investment is greater than the savings. That means a nation is borrowing the difference from its foreigners. So in 2007, foreign purchases of U.S. assets exceeded U.S. purchases of foreign assets by $775 million. In other words, we borrowed $775 million from foreigners. All right, and this has been the norm since 1980. Okay, so remember the last graph I showed you the difference between exports and imports, and they started going apart in 1980. If you want to rewind the video, you can check that it's true. This we also see at the exact same time, right, is the same amount of time that savings and investment started breaking apart, and now there's a difference between them, right? At the same time, we have higher investment and lower savings. That means we're borrowing money from foreigners. That would mean that, you see here's the 0 line for net capital outflow. For the first time, boom, look, we've had extremely negative net capital outflow. In other words, foreigners are financing our investment construction. All right, so why have we not been saving enough, basically, or why has saving been less than investment? Well, in the 80s and then in the 2000s, skipping the 90s, the government ran budget deficits, and so there was not enough money to go around in the savings world. Remember what happens when public saving is zero, or negative, actually. Remember that from previous chapters. And in the 1990s, we had good national saving. We actually had that the government was running, under the Clinton administration, budget surpluses. However, because it was a boom time, we needed to build even more factories and even more investment. And so even though we had good savings, it couldn't keep up with the investment. So basically, for the last 30-40 years, we just have had too low savings for our investment needs. So is this a problem? Well, some people say no, it's fine. What we were doing is we were borrowing all this money, but it was investing it in capital stock, and this will yield large returns, right? And furthermore, if we had not borrowed from other people in the 80s and the 2000s, well, what that would have meant is that we would not have been able to build as much capital, and so that would have made the recessions worse, okay? And so the idea here is that a country, just like a person, can go into debt for good reasons or bad ones, right? If I take a loan just to go party through Europe for 2 years, that's a bad reason to take out a loan. If I take out a loan to build productive investment, maybe that's a good idea. So if a country is running a trade deficit because it needs more capital inflow in order to finance a growth of its capital or its investments, then really that's maybe not that bad of an idea. All right, so what are the actual numbers? Well, as of Halloween in 2013, right, people abroad own $25.8 trillion in U.S. assets. U.S. residents own $21.6 trillion in foreign assets. That means that we owe total, basically, you can think about this. We owe $4.2 trillion to the rest of the world. It's higher than every other country's indebtedness, and that makes us be the world's biggest debtor nation. We owe more to others than any other country. All right, and so this could seem like it'd be a big problem, but it's actually not currently a problem because we earn a higher interest rate on this 21.6% in other countries, because investing in other countries can be a little more risky. We get a higher interest rate. When people invest money in the United States, it's not as risky, so we don't actually have to pay them as high of an interest rate. So even though these numbers are $4.2 trillion apart, the interest that we get from our $21.6 million of foreign assets is about equal to the interest that we have to pay out on the assets that other people own. So we're currently doing okay. However, if debt continues to grow, then we could get into the point where it costs too much for us to pay the debt on this $25.8 trillion, and we may become a drain on U.S. income. All right, so now let's go ahead and jump to the second part of this chapter, is the nominal exchange rate, right? When I want to buy an export or an import, I ultimately have to change my good into a different currency. So the nominal exchange rate is the rate at which one country's currency trades for another, and we always express exchange rates as foreign currency per unit of domestic currency, okay? So as of November 2nd, one U.S. dollar bought 1.13 Canadian dollars. One U.S. dollar bought 0.8 euros. It bought 112 yen, and it bought a 13.47 Mexican pesos. All right, so appreciation is when the value of the currency goes up, meaning I can now buy more Canadian dollars. That would mean the United States dollar is appreciating. It's depreciating or weakening when I buy less Mexican pesos, for example. So during 2007, the U.S. dollar depreciated 9.5% against the euro. That means during that year, I was able to buy fewer euros for my $1, but I was able to buy more South Korean wons. All right. And really, ultimately, what we care about is not the nominal exchange rate, it's the real exchange rate. We don't actually care about nominal variables very much at all, only real variables in this whole entire course. So this is basically the rate of what one goods and services from one country can be exchanged for the goods and services of another. We use this formula, the E times P over P star, where P is the domestic price, the price here of the product. P star is the foreign price, and E is the nominal exchange rate. Okay, let's do an example real quick. So Big Mac is $2.50 in the US, 400 yen in Japan. The exchange rate is 120 yen per dollars. In real life, it's like about 113. If you go back a couple slides, you can see, but I just made this a little bit easier for the math. Okay, so if I take E times P, which is, this is the exchange rate, okay, and this is the price here. When I multiply them together, I get the price in yen of a US Big Mac, right? I just took the 250 and I converted it into Japanese yen. All right, and then, so that gives me 300 yen per US Big Mac, but a Japanese Big Mac costs 400 yen. So when I divide it by P star, I get that there's 0.75 Japanese Big Macs per US Big Mac. Now, what does that make? What does that mean? Does that mean if I grab a US Big Mac and I jump on a plane and I fly to Japan, it only goes down to 3/4? No, that's crazy. What it really means is that to buy a Big Mac in the United States, a Japanese citizen must sacrifice the amount that they could purchase 0.75 Big Macs in Japan, right? So if a Japanese person comes to the United States and they buy a Big Mac, the amount of money they spent felt like only what they would have spent had they bought 0.75 Big Macs in Japan. All right, so go ahead and compute this real exchange rate, right? The nominal is 10 pesos per dollar. The price in the United States is 3, and the price in Mexico is 24 pesos. What's the price of a U.S. latte measured in pesos? Calculate the real exchange rate measured as Mexican lattes per U.S. latte. Pause it, take a second, and then come back. All right, so the price of U.S. latte in pesos is pretty easy. It's 10 pesos per dollar, $3 per U.S. latte. It's 30 pesos per U.S. latte. And in Mexico, they only cost 24 pesos. That means that in Mexico, you can, for what you would spend for one latte in the United States, you could buy 1.25 lattes in Mexico. All right, so with many goods, the price now is going to change to the price of that shopping basket, the consumer price index. P star is going to be the price of the foreign shopping basket. That means the real exchange rate. Same exact formula, I've just renamed P to be the price of the domestic basket of goods relative to the price of the foreign basket of goods, and it's not the individual goods. All right, so if the U.S. real exchange rate appreciates, that means that U.S. goods become more expensive relative to foreign goods. People want to buy foreign goods and not the United States goods. All right, the law of one price. So the idea here is if I can just take a product, buy a product one place and move it to another place, then the good should sell the same, or else people are going to buy products where it's cheaper and then sell them where they're more expensive and make a little money, right? So suppose coffee sells for $4 a pound in Seattle, $5 a pound in Boston. People are going to do, this is called arbitrage. They're going to buy money in Seattle and sell it in Boston for a quick profit. That's going to drive up the price in Seattle, drive down the price in Boston until the two prices are equal. So really, for identical products that can be easily transported, the prices should be equal, even across country lines, okay? This gives us rise to what's called purchasing power parity. Basically, it depends on the law of one price, and it just says that really all exchange rates do is they just adjust so that the prices, even though one is in dollars and the other is in Mexican pesos, the nominal exchange rate just adjusts so that they cost the same amount, okay? And that implies that the price of a basket of goods is just equal across countries. All right, so imagine that the basket contains a Big Mac, where P is the price of the US Big Mac, P star is the price of the Japanese Big Mac, and E is the exchange rate, all right? So remember that I'm just going to move the P star is normally on the bottom here, P star, and then it's equal to the real exchange rate. Well, all I did was I moved the P star over here, okay? Because the real exchange rate, which used to be over here, is equal to 1. That's the law of one price, okay? So that's where I have this formula from. And basically what this tells you is that the price of a US Big Mac in yen should be the price of a Japanese Big Mac in yen. One price, in other words. So when you solve for E, you get that the nominal exchange rate just changes from P star over P. So it's important to note that this might not always be true. This was an assumption. We had to use an assumption that the real exchange rate was equal to 1 in order to get this formula. If at any time the purchasing power parity doesn't hold, meaning the law of one price is not true, then that won't actually be the nominal exchange rate. Okay, so really this is kind of interesting. If two countries have different inflation rates, it will change E over time, right? If the other country here, if the price of this country goes up, but in this country doesn't have inflation at all, that means that the nominal exchange rate is going to increase, right? So here is the example. In Mexico, P star goes up, so that means that E goes up, right? So basically, I used to be able to buy 10 pesos with my dollar. Now I can buy 20 pesos with my dollar. This means that the dollar just got stronger and the peso just got weaker. The peso depreciated, right? So inflation in your country makes your currency weaker. And the opposite can happen too, right? If the inflation is higher in the U.S. than in Japan, then the dollar depreciates against the yen. Some limitations, because this is not always true. One, not many goods can be easily traded. For example, haircuts or going to the movies. You can't buy a haircut in one location and sell it somewhere else. So price differences cannot be arbitraged away, and you're going to not have the law of one price on these sort of goods. The other one is that foreign and domestic goods are not perfect substitutes, right? Some people think that Toyotas are better than Chevys or vice versa, so they're not going to obey the law of one price. If people like Toyotas better, then Toyotas are going to be more expensive, right? So price differences also can reflect taste differences. However, nonetheless, PPP, purchasing power parity, works well in many cases, especially in the long run, right? So basically, in the long run, this is important to know. If you increase inflation, and how do you increase inflation? The federal bank in that country prints too much money. That's important. So if if the central bank in this country, the Fed in our case, prints too much money, we're going to have too high an inflation rate, and then our currency will depreciate. Okay? All right. And so let's look at the data, right? And we can see here in this graph, when we have countries with high rates of inflation, right here, right? Average annual CPI inflation is pretty high. What happens? The depreciation relative to the dollar is also high. So Ukraine keeps getting weaker and weaker against the dollar, meaning $1 maybe was able to buy 1,000 Ukrainian dollars, and then it was able to buy 2,000 Ukrainian dollars, then it was able to buy 3,000 Ukrainian dollars. That means the Ukrainian dollar is getting weaker. All right, so I'm going to finish up asking you 2 review questions. One, I want you to go through and figure out which of these is not true in a country with a trade deficit. All right, and then I want you to go ahead and calculate the nominal exchange rate when purchasing power parity holds. Hit pause and then come back. All right, so basically I want you to be able to go through and say, in a country with a trade deficit, what happens to each of these? Exports and imports, net capital outflow, investment savings, and what does Y and C and I and G equal? All right, so in a country with a trade deficit, that means that net exports is less than 0, right? That means that imports have got to be greater than exports, right? So that's true. Okay, that's good. When net exports is below the 0, I know that net capital outflows also got to be below 0. Okay, so that's true. Very good. Investment is less than savings. Okay, in a country with net exports being less than 0, remember that means that money is coming into that country from foreign. So this is the country. Money is coming into that country from foreigners, which means that the domestic people in here get to invest. They get to invest a lot more than just the savings, right? So maybe there's domestic savings coming in and they're using that, but then they're also using this foreign money, right? Because net exports is less than 0. That means that they can invest a lot, and this is not right, right? Investment is actually more than savings. So this is the answer to answer, right? It's the right answer because it's the wrong one. All right, and finally, let's look at what happens to that Ford Escape SUV, right? What's the nominal exchange rate? Well, I know that P star is 720,000 rubles, and then I know that P is 24,000, so I use the nominal exchange rate that I gave you a little bit earlier. It's just P star divided by P. The nominal exchange rate should be 30 rubles per dollar.